Hey there, everyone. It's Mitch Goldberg. We are live. Welcome to Be the Boss of Your Money. We've got a couple of things to talk about, but if you're a regular viewer of this show, of this live stream, of this podcast, you know that Thursdays are typically the shortest live stream of the week. It's kind of like, let's get out of here already. Tomorrow is Friday. Let's just wrap it up for the week already, because we need to get to work tomorrow, wrap up loose ends. That's what Fridays are all about, right? Wrapping up loose ends, go home with a clear mind on Friday. Market got pulverized yesterday. Today, I wouldn't say like a rebound. I wouldn't say like a rebound Thursday, but I'll give it this: stable. And I would rather have a stable day than a giant rebound day after a big down day, because the giant rebound days just the gains, they disappear too quick. And I think the more the market gets, the more the volatility you have, the harder it is for people to stick with it. Look, the bottom line is we're going to talk about today. I'm going to give you some strategies. We're going to talk about why I think the stock market is in for a bumpy road. I think it kind of makes me Captain Obvious to say we're in for a bumpy road. But when I say bumpy road, it's like anything can happen now. I mean, it is so binary. Either like we're going to go way up or way down, and it's just such a tug of war that it's like today, at least, stocks are stuck. They're just stuck. So let's roll a quick intro, and I'm going to give you the goods. Stick around for this. I really want to make this short and sweet, and I want you to enjoy it, get something out of it. Welcome, live viewers. Welcome to all of you watching in the replay. I would love to answer your questions. So here we go. All right, so what are we talking about today? We have a lot to talk about. I'm going to give you a quick wrap up in the market, but more importantly, I want to give you some wisdom, some perspective, tell you why it's going to be a tough 2 or 3 months. The election is 40 days from today. Let's take a look at a share screen real quick, and you could see that the Dow, after being down over 500 points yesterday, down over 800 at one point yesterday, down, up today, up 52 points. NASDAQ, S&P barely up, NASDAQ barely up. Just nothing was really major. I mean, even the VIX only moved 0.24%. That's the red. That's like a rarity. Usually see the a move in the VIX percentage-wise is much more magnified than a move in the S&P 500. Let's go on to what we need to really take a look at is the Fang Stocks. So Facebook, Apple, Amazon, Netflix, Google, Microsoft, they're all up today. So the Fang Stocks, back to technology, pulled stocks a little higher today. These stocks, most of them, especially Apple, started the day down. They turned around. I'd rather a down day turn into a good day than obviously a good day turn into a bad day. Gives us a little momentum heading to the next day. That is really short-term stuff, but I want to give you an example. Look at these industrials: United Rentals, Korn Ferry, Johnson Controls. Korn Ferry, you might not think of it as in the industrials, but according to Standard & Poor's, it is. Cummins Engines, Federal Express, FedEx. I still call it Federal Express, FedEx. Wabash, ABB. Okay, Granger, John Deere, Eaton Corp, Emerson Electric. A lot of industrial stocks, rather, were up. The usual suspects: Textron, Honeywell, GE. I really have to wonder why even bother looking at GE anymore. And if you own it, I have to question why even bother. Listen, if things turn around and you want to buy the stock, I understand. But we talked about this a few days ago. GE is not a value play. It's a down and out company that is basically surviving on financial engineering, shrink to grow strategy by getting rid of good assets, trying to pay down debt, but nobody even understands the balance sheet. The former CEO, Jeff Immelt, is just one of the worst CEOs ever. Anyway, so they're in bad shape. Northrop Grumman was off. UAL, Lockheed Martin, Boeing down $5. Boeing below 150. That hurts. That is definitely a minor injury for the market. Let's take a look at reopening stocks. They were down. This is a shame. These reopening stocks. These are kind of the ones that you think of that could affect you. Planet Fitness was down. Airlines are down. Marriott down. Southwest was down. Norwegian Cruise. Norwegian Wood. I don't know. Remember that song by the Beatles? I have it in my head now. Sector ETFs. The most important thing I look at every day. When you see the utilities and consumer staples lead the way, that is basically, though, a worry that they're just slowing down. And then we're going to talk about that. Technology was okay. Who was at the bottom? Healthcare. Consumer discretionary. It was a mixed day. Look, I'm not saying today was a bad day. Today was just one of those. Today was just actually, it was just a really, today was a really boring day. That's all it was. So we're already on for 6 minutes. I want to wrap this up. If you're watching, stick with me. All right. Just chill. Ask me a question in the comments, for God's sakes. Give me something to do. Let's stop sharing the screen. Who's out there? Hey, John. Good to see you, my man. So let's talk about why it's a bumpy road. The elephant in the room, the one that makes me Captain Obvious. So the reason for a bumpy road for the rest of the year, does it make me Captain Obvious to say it's the election, stupid, right? We all knew that. So are we going to get a contested election? A lot of people are gearing up for that. Both sides, Democrats and Republicans, are lining up. They're lining up their lawyers. Maybe that's the right phrase. They're lining up their legal teams. It is now in doubt whether or not President Trump would actually step down as president if he were to lose the election. And he's painting things into a corner. Like, if I win, it's because I deserve to win and everybody voted for me. It's legitimate. But if I lose, well, it's because it was fraud in mail-in ballots and fraud everywhere. So he's setting up a situation that's saying, heads I win, tails you lose. So it's legitimate if he wins, but he's sowing a lot of mystery and questions if he loses. And so that is one of the things that is worrying investors today. This has never happened before. It's usually, you're president, you lose the election, you exit the White House, you write a book, you make a lot of money, and hopefully you have some fun, stay involved in policy, do whatever you do, where you do some nice, painting like President George W. Bush, and it's all good, and we get going. So that's one thing. The other thing is the policies of the policies of the politicians. Today, Trump said he wants to make sure that no one has a problem with pre-existing conditions. That's kind of maybe a step to attract suburban women, the center. Yeah, it's really about politics. Biden released some policies today that says, maybe he's going to be a little bit more progressive than people thought and not really move to center the way a lot of people would have thought. There's just a lot going on. It's so much uncertainty. The debates are next week, I think. So that'll be interesting to watch. Some people think it'll be interesting. I know some people who don't plan on even watching. We've got a couple of people out there. We've got Keith and Gary. I'll throw your comments up in a second, okay? So we've got the election, and then we've got the economy. Goldman Sachs cut their GDP forecast basically in half for the coming year. The COVID worry is that, England is going back into not a complete lockdown like they were a few months ago, but they are starting to shut down a pretty big part of their economy. We are starting to open here. It's really tough to determine what happens. I mean, some of the states like Florida and Texas, they had a surge, but the surges seem to have calmed down. Right? It did calm down, but now the surge is coming elsewhere. So really what you're looking at is a whack-a-mole approach. Remember that game Whack-a-Mole? Whenever the mole would pop up, you keep, batting it down with the plastic hammer, like when you took your kids to Chuck E. Cheese. And so that's what's happening. So it's a whack-a-mole approach. Spain, Italy, England, even Germany are seeing spikes in COVID cases. It is getting a little colder out, but I think with masks, this is paper, but it's it's okay. I can do okay with this. But with the masks, the contact tracing, things look a lot better. We can handle this a lot better. Hospitals know how to treat this much better. It was a real disaster. I actually know personally. I know doctors here on Long Island and in the city, New York City, and it really was, a true hellscape of what was going on. So maybe we're a little jaded here in New York, and we see things half empty as opposed to half full. If we get a vaccine, great for the market, great for the stocks in due time. I don't think it means stocks pop right away and the economy turns around right away. There has been a lot of doubt about vaccines. Politics have infiltrated the FDA and vaccines. So is the vaccine out because it really works, or is the vaccine out because it's good politics to get everybody to think they should go out to the mall and the movies and the restaurants and fly again and travel again and go back to their offices, et cetera. So that's another thing. Earnings have been coming out okay in a lot of areas. Like one company, Darden Restaurants, who owns the Olive Garden, stock is still in the 90s, holding up great. And they raised their dividend today. And I see a couple of companies are going to reissue or re-engage in buybacks, which if I were a CEO, I wouldn't want to spend money on buybacks now, because if we do go into another shutdown or the economy doesn't pick up the way we had hoped, you're going to wish you had that money. Listen, airlines are asking for bailout money. They spent almost $40 billion in buybacks, and then they need like more than $40 billion in aid. It's not a good way to spend your money. But we have to bail them out, I guess. There's a couple of people out here. Keith, what's up, my man? Projections for the fourth quarter. Do you agree with the Federal Reserve Bank of Atlanta 32% GDP in Q3? The answer is probably, and it's not really an answer, so I have to say yes or no. So I guess I'll say yes. The reason is this: the Atlanta Fed's GDP starts at a blank slate every quarter, and then as statistics are released, that's automatically factored into the Federal Reserve Bank of Atlanta's GDP Now figure. That's what it's called. It's the GDP Now forecast. You could look that up, GDP Now, Atlanta Fed, and you'll see it. So if the first number comes in bad, then the GDP forecast just goes right down. It just right through the floor. And if the next number is good, then it goes back up. So it only goes by a very limited amount of data from day one of the quarter. And you don't really have enough data to make any analysis until you get to the end of the quarter. It is a backward-looking number. It doesn't really tell you what the fourth quarter is going to be. So what I would say is we're at the end of the quarter, basically. So pretty much all of the data that you could squeeze into that figure is now in. So if we had a great data point in the beginning of the quarter, okay, in July, then the GDP now would be way up. So it's just as more data comes in, the less the figure moves around. So that's my answer. So if they're sharing down 32% drop in the third quarter with a full quarter's worth of data, it's probably going to come true. Thank you for asking. So thoughts on Peloton and SPI? Okay, so Gary, here's the deal. I appreciate you greatly watching this. I'm going to answer. I'm going to answer generally. I know you want the specific stocks. First of all, I'll say this about Peloton. I have never seen a fitness product come out that has so much loyalty. It's more than a bike. It's more than a screen. It's really a community, an online community. I look at Peloton as like another social media platform. You have Facebook, you have LinkedIn. By the way, I don't know if you noticed, but LinkedIn got stories today. You can only see it on the mobile app. Okay, so you have to go to your phone on the mobile app. Okay, here's my family. You see that? They're so cute. So you could only see it on the mobile app, but LinkedIn does have stories. It's pretty cool. I've been wanting stories on LinkedIn for a real long time. To me, it would just be a nice, fun addition. I think people look at stories sometimes and not even what you post in your timeline, 20-second limit on videos. It's pretty similar to Instagram. You can't double tap. Maybe you can double tap the pictures. I didn't try, but they give you like a couple of quick reactions, like a thumbs up, a heart, smiley face, just like Instagram. So I'm happy about that. I'm a big LinkedIn user. So, oh yeah, Gary, you asked the question, didn't you? What the F were we talking about? Peloton and other stocks. I consider that the work from home stocks. My thought is the stock is up a hell of a lot. And if you want to own a hot stock, you've got to be prepared for the hot volatility that comes with it. As far as a company goes, I remember when Netflix came out and people said, oh, there's going to be imitators and, other companies are going to have something like Netflix. All this time later, and with Disney Plus and Time Warner and everybody else, and Amazon Fire came out with a new device today for Amazon TV. Netflix is still the king. So I think Peloton is the king of that industry. I think Peloton can go from bikes and treadmills to other areas in mobile digital products, digital fitness. So I'm pretty excited about it. I can't comment though on whether if you should buy the stock right now or not, but I think it's a fantastic company. What they've built is incredible, and that's what I think. Okay, hope that helps. Okay, so Carlos is out there. Hey, Mitch, don't forget your friends in Florida. Absolutely, buddy. You texted me. Thank you very much. We've got some stuff to talk to you about. Shana Tova to you, my friend. Good to hear from you. And where does one go for safe yield in this environment, Mitch? Man, that is like the $1 trillion question. I actually made a whole live stream about that. I had a humble brag. All right. So I looked at some of the websites that aggregate the CD yields all around the country. Pathetically low. In fact, a friend of mine just asked me about where he can put six figures into short-term money also. And I looked at that, and I showed him the ETFs, and what the ETFs are from iShares, which is owned by BlackRock, Vanguard. There's a few others out there. Low duration. It really depends what you want. I'll start by saying this: nothing that pays a good yield is safe, and nothing safe pays a good yield. I don't see any middle ground in that either. I looked at ETFs like MEAR from BlackRock and some of the other low duration, like really low duration. Low duration means that the ETF will have less volatility from changes of interest rates. If interest rates all of a sudden spike up, these should hold up pretty well. They could lose a couple of cents per share, like 50 cents down to 48 cents, 47 cents per share, maybe 45 cents per share, as an example, a mathematical example. But if you're looking for something that really can't budge, you don't really have anything that pays yield. It's really just about preservation, cash equivalents, savings accounts, CDs. There's really nothing else. Short-term T-bills, 30 to 90 days. There really isn't anything else to go into, which is why baby boomers are loaded up to the gills. They're just overloaded on stocks. I've been in the industry now for 30 years, securities industry. As I think you've been in it even longer, Carlos. Keith is out there. He's probably been in it longer also than I have. But in my career, I have never seen people of baby boomer age hold more stocks in their portfolios than I do today. And that's because they're chasing yield. They're buying stocks for dividends. This has a 2% or a 3% dividend yield. One popular stock that was people love for the dividend was Kraft Heinz. It was a disaster. A lot of them like AT&T, but AT&T is like a flame, and the baby boomers are like the moths. The moths attracted to a flame, and they run into AT&T. Go, oh, it's got a 5% yield. It pays a 5% yield. It's got a 5% dividend. It's like a broken record. It's kind of pathetic. And I'm like, they don't earn enough money to actually pay the dividend. They've got over $100 billion in debt. Actually, a lot more than that. And I don't know the exact amount. It's over 100 billion. And they have to invest so much money to keep up with 5G. And they're already talking about 6G. I don't think stocks with very high dividend yields are a place to be now either. So unfortunately, I'm beating that horse with a dead stick. There is no alternative. TINA. There is no alternative except for stocks with dividends. But I want to see companies growing their earnings, not just paying a fat dividend yield. When a company gets to the position where, like AT&T, where the only value proposition is, their only value proposition is that they're maintaining a dividend. It's not good enough. It's just, I think it's a recipe for pain. And even if they do keep the dividend and they get into growth again, it's only one stock. I mean, how many stocks you can have in your portfolio? One? Hopefully you have a lot more than that. Hopefully you're diversified, right? Diversification. It's not a return maximization strategy. Diversification is a strategy that we use to minimize risk, but doesn't necessarily protect your portfolio from going down in a generally down market, right? It's not a maximization strategy. Really, diversification is, we use it to prevent the worst investment in your portfolio from becoming your entire return. Michael is out there. Mike Okon, thank you very much. And I had Eric Okon yesterday as my guest on my live stream. He was just great. You guys know so much about business and social media and marketing, and it's just incredible. Carlos, thank you. Johnny is out there. And I agree with you, buddy. I'm with you, Carlos. So that's really about it. I think we're going to wrap this up. We're on for over 20 minutes. That's enough, right? I mean, do you want to see my face more? I've got plenty of content on LinkedIn, on Facebook, on Insta, at YouTube. So if you want to see more of this face, go check out the content, and I will speak with you soon. Happy Friday tomorrow. Have a lovely weekend. And if you're going to be out Monday for Yom Kippur, for all to whom it applies, I wish you an easy fast. Handsome devil. I'm going to have to take a screenshot of this. Thank you very much. Talk to you soon. Bye.